We're talking today about an asset that affects everybody because everybody needs a place to stay. Whether you're renting or buying, real estate affects us all. Briton Hill is the president of Weber Global Management, and today we'll be discussing how to pick real estate investment strategies, and the jurisdictions you should be looking for and how to pick those jurisdictions. Briton, welcome back to the show.
Hey, David. Thanks for having me back. Good to see you again.
Good to see you. We had you on the show a couple months ago, and you had talked about real estate as an asset class very briefly. Today, I want to dig in a little bit deeper and talk about all the different strategies an investor should be aware of, as well as how to pick real estate. I'm talking about residential and commercial, but for the viewers watching who are mostly retail investors who want to buy a home for themselves, mainly the retail side. So before we talk about the strategies, I want to dig in and talk about your outlook on the real estate market first and foremost. Interest rates are projected to rise. Actually, most banks that I've looked at are already ticking up their variables. Their credit lines of credit, for example, are ticking up. So we're seeing interest rates on the commercial banking side tick up even before the Fed raises anything. How is that going to affect the markets?
It's a really good question, David, because we really have two forces at play here right now. Three forces. First, you have the inflation, which is going to inflate asset prices. And then in addition to that, we have supply chain issues and we have the risk of rising interest rates. So inflation will cause rates to rise, which obviously if your borrowing costs are more expensive, it's going to be more expensive to get a mortgage. And if that starts pricing people out of the equation, well, house prices are going to have to come down in order to be able to meet that demand. But in favor of appreciating house prices, you have things that are really, really hard to get. I know we've spoken in the past. I'm in the process of building a house here in Utah, and we keep getting delay after delay after delay. And, if we want to beat the delays, that means we just have to pay substantially more for our housing goods and our housing materials. So it's kind of a little bit tricky right now where you have one force that's going to be driving house prices down, and then you have another one that's propping house prices up. But I think overall, there's a greater headwind for further appreciation in most areas than there is a tailwind. For the past 40 or so years, we've had interest rates falling and we've had a great bond bull market that's pushed asset prices up. And we're starting to see those forces change a little bit. And I think a big determining factor here will be how long is it going to take to get this supply chain crisis under wraps, because that's putting a lot of pressure on shooting house prices up just because building costs are so expensive.
But you don't think rising mortgage rates, suppose they do rise, you don't think rising mortgage rates are going to put a damp on demand for housing this year?
I think it depends on how quickly we see things rise. If it's moderate increases over the course of the next year, I think that the areas that are still doing well for housing, areas like Utah, certain areas in California, Florida, there are booming housing markets right now. I don't necessarily see that boom coming to a halt. Especially because there's a lot of demand for the spec home market and, mid-sized, good starter family homes. I think that market will continue to do well, especially if you're well positioned. But there are areas where people are leaving and those housing prices and real estate prices are coming down. New York, for example, and New York City and Manhattan.
That's right.
Those housing prices are struggling right now, and they're actually seeing more of a sideways market as opposed to Utah or Florida, where those prices just seem to go up without end.
Just to be clear, New York, San Francisco, those markets are, in your words, struggling not because of rising interest rates, right? They're struggling because people are vacating as a result of COVID?
I think it's a little bit of a combination of both. You have people vacating to cheaper areas that are more tax friendly and a little bit safer and easier to live in. But also you do have that headwind. You do have those rising interest rates that are affecting things.
Real estate as an inflation hedge. I've heard this from many economists. I've heard this from traders as well. Do you think real estate is a better or worse inflation hedge than, let's say, gold or stocks, given its performance?
The only reason I would say it's not as good of an inflation hedge is because it lacks liquidity. If you really needed to get liquid in an inflationary crisis, which typically means you need something to pay off credit because your rates are rising. And so why would you need to liquidate an asset if not to pay down some debt potentially? I think if you are looking for cash, obviously gold and stocks are going to be better because they're more liquid. But I would actually put real estate ahead of stocks because stocks are usually the first things that get hit as people scrounge for liquidity. Gold, traditionally for thousands of years, it's been a great inflation hedge. So I think gold will perform better than all three of those asset classes. But real estate, as long as you're not over leveraged, as long as you can continue to make those payments and keep your house or keep your investment property, I think you'll do well in an inflationary period as long as you're not forced to sell to cover other obligations.
So on that note, let's talk about strategies for investing in real estate? Because as you said, it's not always the most liquid asset to invest in, but there are derivative products that you can buy and trade in that are much more liquid. Let's talk about that first, and we'll talk about other strategies.
Sure. Derivatives, obviously, you can buy REITs and real estate funds on the stock exchanges, and those are great liquid ways to have real estate exposure without being directly exposed to illiquid real estate. So the one concern with that is if we enter a period where people need to raise liquidity, you could see the prices of those REITs and the prices of those shares fall, and that can affect investors adversely. And it may not have really anything to do with the underlying fundamentals. It could just be people need cash. People need to pay for debts, to cover variable interest rates, or they got overextended over here and they were hoping for more asset appreciation. So that's the risk there. You can see those prices swing wildly to even trade at a discount. But if that happens, I would say that's a good buying opportunity. The other thing, I would really try to dive down into their financials now more than you have in the past. You want to see how much leverage do they currently have? Are they levered to the hilt? Are they relying solely on increased asset appreciation? If they were, I wouldn't necessarily want to touch those, because I think that asset appreciation, especially in the investment sector, could slow. I think the single family home market and that market will continue to do well and be okay for most people in most areas. But I really think the biggest risk now, especially is commercial real estate, where we've seen so many people go remote and they've been successful in doing so. And these businesses are now looking at things and saying, wow, I don't need 100,000 square feet of office space anymore. My people can work from home. We found ways to help them maintain efficiency through technology and platforms like Zoom. So I think the commercial real estate, I would shy away from that, especially given all the factors right now and the inflation and rising interest rates.
Okay. All right, let's talk about buying real estate, residential real estate as an investment. Let me ask you this, Briton. Do you buy residential real estate for yield on capital appreciation, or do you buy it for yield, for rental yield? What's your thesis there?
I think you always need to look at the rental yield. I have a good friend in Utah who massive developer. He runs a multi-billion-dollar real estate company here, and he was burned in the 80s buying real estate, simply looking for price appreciation. And he created this thesis. He's like, you know what, never again will I buy an investment property solely for price appreciation. It needs to be being at least something, even if it's not covering 100% of the overhead, it needs to at least be covering a portion of it, because he found himself caught in a really hard spot where he had tons of properties that weren't selling because interest rates were swinging all over the place in the early 80s and late 70s. And he was burned badly. He ended up wiping out most of his savings and everything that he built up over the past several years. So I'm of the same opinion, his same mindset. Always try to get a little bit of a yield from your investment property to cover some of your expenses, because worst case scenario, even if things slow down, and what if appreciation, instead of going 6 to 10%, we slow down to 1 to 2%. Well, that's not a lot, but if you have a little bit of a yield there to help cushion you, you're going to be in a much better position.
I have a friend in Vancouver. This is a real example. He was looking to buy a condo for himself, a 1-2 bedroom as an investment property. And he was asking me, David, should I do this? Should I pull the trigger? Because he's looking at a property at about $800,000 Canadian. And he needs a down payment of about half of that. So half of $800,000 is $400,000 is going to be from cash. That's his equity. The other is going to be mortgaged. And rates are relatively low these days. But if he did the math, and he calculated that even if he rented out that property, he would barely cover his mortgage and then some. So he's looking at a 2-3% rental yield. And I said to him, well, you've also got to consider the capital appreciation side. I mean, it's expensive in Vancouver, yeah, for sure. No one's going to deny that. But the housing market is still growing. How would you respond to that question? What would you say to my friend who's on the fence about buying something that has a low rental yield but potential for capital appreciation?
Well, I think that I would feel comfortable making that investment for a couple of reasons. One, there still is a little bit of a rental yield. Two, you said he's only having to put half down, the other half he's paying out of cash.
Exactly,
correct?
Yeah. 50% of the value of the home, $400,000 is just cash. That's a sizable, if not all, of his savings going into one asset class. And you told me, well, David, why would I do this when it's only yielding 2-3%? Why can't I buy stocks or cryptocurrencies, which admittedly are more volatile, but has the upside that's considerably larger, right? That's a fair question. I'm not giving him financial advice. I just said, I don't know that, but that's a fair point. What would you say?
Yeah, it is a good point. And I guess what I would say back to him is, how much real estate exposure do you want? How much stock exposure do you have? How much crypto exposure do you have? If he's already exposed in those areas, we're seeing immense volatility in that market, and that volatility hasn't transitioned over to the real estate market yet. So I would think his healthy down payment, he's got a huge down payment into a property in a market that you said is appreciating well. I don't know the Vancouver market as well as I do markets in the US, but if the markets are doing well there, he's got a really good down payment. Worst case scenario, he can always refinance that back out at hopefully a good low rate still. But I would look at that as, if he wants to do a big down payment on something, just to have money out of the stock markets, which are very volatile, out of the crypto markets that are very volatile, while getting good real estate exposure. The yield isn't the best, but if there's price appreciation there of 6 to 10% a year, well, then he's doing a lot better. So I would feel comfortable under those circumstances doing something like what he's doing. Absolutely.
All right. So looking at the U.S. then, what are some jurisdictions you think have good potential, and two, good rental yield right now?
Good potential and good rental yield. I think Utah is a really good one. Utah, Idaho, Arizona. These are all areas that people in California are migrating out of, and other states, as well as good economics. I mean, Utah is kind of an anomaly here where we have a really large Mormon population, and Mormons are really interesting in that they tend to stay really close to home. So there's a huge community aspect, and Mormons also have a lot of kids. I grew up Mormon. A lot of my friends had massive families, and they're staying close to home. And you have these millennials now in a good economic environment that are buying their starter homes. They want to start getting into homes. They want to start getting into townhomes. And so this median range of anywhere from 350,000 US to 800,000 US, they're getting snatched up the moment they hit the market, and oftentimes for cash. So I think areas where you can identify like that, where there's good economics and sometimes unique things contributing to the economics, like the Mormon population here in Utah, and also areas where the taxes are lower. The state tax in California, you're paying as high as 14%. In Utah, it's 5%, and you have a lot of the tech companies and the businesses moving here. And so it's really unique in that businesses are starting to position themselves in these cheaper areas. But I also like the Southeast areas in Florida, where Miami, for instance, is getting very, very expensive to live and to own a home. And so you have a lot of people fleeing out into the suburbs, like Hialeah, for example, is just really starting to grow and boom out there. So I really like that area. And I think that also finding some interesting ways to get real estate exposure without having direct exposure, via lending and hard money lending on deals. If you're cautious and you position yourself well there, you're theoretically buying a put on the real estate market that pays you a premium, David. And how that works is, for example, we're setting up a fund right now. We should be ready to go in about a week or two, and we loan to contractors, flippers, developers here in Utah that either need quick cash, bridge capital, bridge loans, or they're new entrants into the market, so they don't have sufficient credit to get a standard loan from a bank. And so by loaning out at a 70 to 80% LTV, loan to value, so on a $500,000 starter home, we'd only be loaning $350,000, and the developer has to put up the other $150,000. So they have major skin in the game. And if they default, worst case scenario, I have to reclaim a property, but I get it at a 30% discount. These notes are typically 6 months to a year in duration. So the real estate market would have to crash anywhere from 30 to 60% in a year for me to lose my money, which I definitely don't foresee that happening. In fact, in Utah, the real estate market hardly fell at all during 08 and 09. So we'd have to have market correction much worse in 08 or 09 to be hit.
I've heard horror stories of developers defaulting. People buy a condo pre-sale, and they take your money, and nothing gets built, and poof, that money disappears. It's not common, of course, but it's happened. Red flags you will look for before signing a deal with a developer.
Yeah, the first thing we look for, obviously, is how much skin in the game do they have? What collateral do they have, if any? I look at the assets of their LLCs, or sometimes I'll even make them do a personal guarantee. But the biggest thing we do, David, especially on a new development, is we hold the money in escrow. So if I'm loaning a developer $500,000, I'm putting that in an escrow account. He's paying interest on the full amount from day one. And he does monthly draws of, say, $50,000 a month for the next 10 months. And it's based on a timetable and based on objectives and points that they hit as far as building goes. So we know that, all right, before he can make his next draw, building will be to this phase, and we'll ask for pictures. We'll go and inspect the site. We'll make sure he is on track and everything, so that our level of collateral is always I guess, aligned with how much money we've lent out. So we know we can always reclaim the property at some point if need be. So that's one thing you can do to make sure that, I just gave this guy a bunch of money. He said he was building a condo and now he's disappeared somewhere.
That's right.
That's one way you can protect yourself. But also, really dig down, look at their books, make sure that they don't have any other liens on the property. You always want to be first lien on the properties, no matter what. First lien always. So that way you're the first person that gets the money back. And then make sure you understand the area you're doing these loans at, because a $500,000 home in Utah isn't equivalent to a $500,000 home in LA. So your collateral is going to be way different. So make sure you know your market well. You have good appraisers, somebody that understands contracting as well. You need to know a good contract, because if things default and you need to go and reclaim that property and finish renovations to sell it, you don't want that to be sitting for months before you can line things up. And it's especially tricky right now where it's already difficult to get things done. But
yeah, pre-sale flipping is something I've seen, especially in Canada, in the big cities where new condos are going up. It's super hot right now. People are buying something before it gets fully developed, and then they have the deeds on that property, and then before the property is built, 3 years down the line, they flip it. They sell the deed to another buyer for 20-30% markup, even 50% in some cases. Is that something you've seen? Is that something you would advocate for? Is that as a strategy?
I mean, absolutely. If you can get a hold of a deed and then have it sold at a higher price before it's even built, why not? You're effectively wholesaling at that point. So there's a lot of ways to make money in real estate right now, but I think the biggest thing.
Tell us about some of the strategies that you've seen that you like.
Yeah, I think that the biggest thing right now is it's a lot harder to just directly purchase real estate and get that good yield. 5-10 years ago, it wasn't uncommon to go and buy a multifamily rental complex at a 6 to 8 cap, and you have positive price appreciation on top of that. What we've seen though is those caps have kind of evaporated. So you're banking mostly on price appreciation. And the risk here is, like we talked about earlier, David, the rising interest rates, which can put a headwind to further price appreciation. So you need to be smart, which is why I like the hard money lending realm, because I'm charging 10 to 12% interest on the cash that I'm lending out, while I also have good downside protection. So if this developer defaults, great, I get his property at a discount.
Is that something everybody can do? I know you're a fund manager, but for the average guy just buying a home, how does that strategy work? Can you walk us through the mechanisms? Absolutely.
So it can definitely be done on a small scale. I started out doing it individually, direct to notes. I have family and friends that are doing it similar in Utah. And so what you need to do, the biggest thing and the hardest thing to find, is somebody who needs to borrow money. So you need to put yourself out there, contact wholesalers, contact developers, contractors. Maybe you even have a friend who's a contractor or somebody a colleague, and just say, hey, if you're ever looking for financing for a deal, please let me know. And it's really as simple as that. You're going direct to him at that point, and then it's up to you to structure the terms. But it's worth paying a few $100 to have an attorney draft out your documents, and also to become acquainted with the state laws, because every state has different laws when it comes to this sort of thing. For example, in Utah, you cannot do any lending like this on a primary residence. So somebody who wants to do some renovations on their homes can't do that. I'm not sure if that's true in all states, but at least for Utah it is. You have to be a mortgage lender in order to do that. So it really, that's as simple as it is. Since it's hard money lending, just find somebody who needs the money, pay an attorney to draft your docs, a couple $100 usually, and you're good to go. And then obviously it comes down to good analysis. Make sure they have skin in the game. You want to be first lien on that property, and you want to make sure they're putting at least 20 to 30% down, because that's going to give you a sufficient cushion. So that's our criteria, and we've been able to do well with that. But, we pass on deals, and you have to be willing to pass on a deal.
And for the buyer, let's talk about some other strategies I've heard. Buying distressed or foreclosed properties is something that friends of mine have done. They're looking for things that are foreclosed. They sell on the market for very, very cheap. Then, depending on the state of the condition of the home, maybe they might do some renovations, maybe not. But what's your take on that strategy?
Absolutely. I think it's a great strategy. The difficulty with that now is most foreclosed homes are sold really quickly, and they go to massive wholesale groups or the banks. And so it's difficult to get into that market. But hey, if you can step in there, find a distressed seller, that is a great way to find a fantastic property. And, sometimes it's as simple as just asking around. It's just gotten more difficult to easily find deals right now, but that doesn't mean that it can't be done. That doesn't mean you can't go out there and still find amazing deals with great value.
Common question I get from my friends, how much should I lever myself? I mean, obviously, the banks will give you a cap on your mortgage rate and your percentage of equity that can be mortgaged on. But let's say you have a choice. Let's say you can go all the way down to 10%, even 5%, I've heard. Should you?
Right now, I would err more on the side of caution, and I would try to put 15 to 20% down if you can. I know not everybody's able to do that, and I'm talking more investment properties wise. I think your primary mortgage is different because you're saving up. That's your house. That's probably the last payment you're going to stop paying. Like food and shelter, you're gonna try to keep making those payments. But for investment properties, I think that you should be as cautious as you can right now, because if those home values start slipping and if we start having an economic contraction and things like that, we could see those house prices fall 10 or 15% over a couple of years, similar to what we have seen in the past when things get rough. And you don't ever want to be underwater on your loan.
Why am I getting a sense that you're a little more cautious right now? Why is that? Are you sensing some systemic risk on the horizon that may dampen the entire market?
Yes, I certainly am. More so, I think that we're going to see things that we just haven't seen in so long. I mean, we have the highest inflation in the U.S. and globally, really, over the past 40 years. It's the highest rate it's been. And so when you take that into account, these markets haven't been able to digest something like that. And most people alive today who are investing have no recollection or weren't even around them when that happens. And so I think that this change in economic forces could cause a lot of volatility. And personally, I haven't even been able to fully digest who is at most risk and where to put your money, because naturally in an inflationary area, you would want to put your money in inflation hedges like gold. And the argument was made for Bitcoin, but we've seen Bitcoin fall this year. It's volatile, and even gold is sideways. And so traditional hedges, they aren't doing well. And I think it's because people are nervous and they're looking for liquidity. So they're running to cash, but cash is losing 7% a year. So it's challenging. I'm trying to be very cautious right now, David, just because I'm trying to, I guess, as unemotionally as possible, be able to look at things. And I know the more leverage I have, the more emotional I typically tend to be. So I'm trying to be as conservative as possible. I'm not saying it's always going to be this way, but at least until I can fully digest and the market can fully digest, what does inflation mean? How long is this going to be around? Is this a long-term or a short-term type of deal? And it's looking like it's going to be more long-term. The Federal Reserve in the U.S. has since said,
I'm going to list a few risks to home prices, residential home prices, and I'll ask you if you think these are relevant risks. The first being that housing prices have gone up tremendously over the last year in many jurisdictions in both Canada and the U.S., primarily because even though demand hasn't skyrocketed. And I'm not talking about places that people from New York or California have migrated to. Just overall, demand hasn't really skyrocketed, especially during COVID. You can't physically go out to go view a home, at least in the early days of COVID. So demand has relatively stayed stable, but supply has really crunched due to a number of logistical factors, and also the fact that people just haven't been going out to build when they're, when in the middle of a pandemic. And so with logistical and supply chain issues recovering, do you see that supply and demand equation balancing out when things reach equilibrium? Do you see prices falling as a result of that?
I think that renovations will come down dramatically. The amount we're seeing renovations, and not necessarily demand, because as you said, demand stayed relatively stable and it even kind of dipped a little bit. But what I think we will see is renovations come to a halt if things normalize, people start going back out. And it's because how many times do you really need to fix your house? The reason why so many people are fixing their house right now, I think, is because they're home. They're stuck at home. They're not going to work. They're working remote, and they're looking at this. Oh man, that's kind of an ugly countertop. Well, we're not really going on vacation. So, this 10 grand, let's redo the kitchen. And I think that, one area we can really look at to get an idea is Peloton. Peloton did really well during the pandemic when gyms were closed, but the question needs to be asked, how many times do you really need to buy an exercise bike in your life? And then once gyms open back up and you can go back out and go to the gym, people do it. People want to be outside. And so I think that renovations will stop. We'll see maybe some subcontractors struggle for work, but overall housing demand, I think, will remain constant.
And I'm just looking at the data here. New housing starts. Is that data that you look at? This is data from the Census Bureau. We'll put a chart up on the screen for the viewers. New residential construction. So I'm looking at the chart. Permits have spiked up dramatically over the last couple of months. They've dipped down during the pandemic. In the last couple of months, they spiked up. Housing starts overall have been flat and then dipped up again. So what does that mean for the market?
Like you said, things dipped during the pandemic. Things weren't moving as quickly, but also we're kind of coming into that springtime where 2 years post-pandemic, a lot of developers have made a lot of money, and so they have cash and they're starting to break ground for new homes. But one thing we have to realize is, just because you have a permit doesn't mean you're going to be able to build the house. We can't get windows on our house and it's been 8 months. So I think that a lot of developers are going to run into difficulties just getting materials right now. And that's going to be
How much of the run-up in prices in homes was due to the lumber price going up?
Oh, a lot of it. I mean, lumber is a base material when it comes to building homes. I know that when we were signing on our house, it was last July, and they were really struggling and really having a hard time as to where to price things. Because once that contract is signed, I mean, they're pretty fixed on their price. And so I know that has affected house pricing because it inflated things. The developers, the contractors, they had to get ahead of themselves a little bit, because if prices keep rising how they were, I mean, they would have been underwater on all of their homes. So absolutely, lumber prices have contributed.
So is it safe to say then, Briton, that if lumber prices fall down or normalize, that housing prices would also fall with lumber? Is that an accurate statement to make? Or not necessarily?
I don't think so, because we've seen commodity cycles where commodities go up and they go down, and the prices of homes never seem to follow the commodity prices directly unless they're going up.
I see.
So yeah, I'd have to think more about that, but I don't necessarily see the price of lumber getting cut in half, dramatically reducing the cost of homes, because costs of other things have risen so much. I mean, copper, steel, things like that.
Yeah, that's a good point. Lumber is not obviously the only thing used in the house. That's a very good point. Finally, I want to ask you, as an investment property, condos versus houses, single unit family homes, what's your take? What would you recommend?
I would avoid condos in big cities like, San Francisco, New York, where people are kind of selling their condos and moving out. But I tend to like condos and townhomes simply because you don't have landscaping, and you can, if I'm buying a few of them, it's almost as much work to manage 5 condos as it is to manage one single family home, if that makes sense. And you don't have to arrange somebody to mow the lawn, or, you can always make them do it. But I like to do as much as I possibly can for my tenants. So condos, and they're a lot cheaper as well. So maybe somebody who's just entering the real estate market, trying to make their first real estate investment, condos are relatively easy to get into because oftentimes they're a lot cheaper than homes. But single family homes have a really strong buyer base, where a lot of your condos are more renters. So if you did ever need to, say, flip, and you wanted to turn around and sell your single family home, I think you'd have a lot easier time, especially in this market, selling a single family home than you would a condo. Okay.
All right. Well, Briton, I want to thank you so much for your thoughts today. Excellent insights, very detailed analysis, and I'll have you back on next time to talk about markets and cryptos and stocks and other asset classes. Thank you.
Thank you, David. Take care.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.